A debate is opening up in the country about the best path to take to ensure post-COVID-19 economic growth and recovery. The governing party has agreed to an expanded role by the presidency in this, and in its economic reconstruction document was looking at leveraging state capacity, inherent authority and capabilities in leading society for the recovery after the COVID-19 lockdown. Now, addressing a webinar to London investors recently, we had ANC Treasurer General Paul Mashatile saying that the new economy must be more inclusive and sustainable, and in building a post-COVID economy, it's back to the RDP. And he talked of a planned 350 billion rand infrastructure spend on networked industries, things like rail and ports and broadband and basic services like water, housing and electricity. Now, the ANC Treasurer's outline dovetails with the Sustainable Infrastructure Development Symposium. That's due to take place just ahead of the new budget at the end of this month, and unveil an infrastructure pipeline from 6 priority sectors. And then last week we had calls from the private equity industry to increase prudential limits on asset allocation imposed by Regulation 28 of the Pension Funds Act. Now, if you throw in the spectre of prescribed assets, you have a potentially poisonous cocktail for the economy, but done the right way, and it could present a pathway to prosperity. Well, to discuss how this all comes together, let's welcome our panelists. Former head of the largest pension fund on the African continent, the Government Employees Pension Fund, John Oliphant. He's currently chair of Third Way Investment Partners, All Weather and RH Bophelo. Langa Madonko, SAVCA board member and new deputy president of Absip, the Association of Black Securities and Investment Professionals. Dr. Eugene van Rensburg, director and investment principal of private equity firm Hlayisani Capital and Investec. Chief economist Annabel Bishop, who is our economist in the room today. Langa, private equity and venture capital, it plays a crucial role in the economy. It invests broadly, it stimulates growth. It also has something of a reputation sometimes of being an asset stripper. I think it's put that largely to bed, though. As we look to recovering after the COVID-19 crisis, the importance of this role is in stark relief. What are the two key proposals here that SAVCA has put on the table regarding Regulation 28?
Well, thank you very much, Michael. I think the proposal that SAVCA has put forward in terms of Regulation 28 is first and foremost that if you look at Regulation 28, private equity, venture capital are also lumped together with hedge funds. So the first proposal that has been put forward is that there needs to be a separation of the two because the asset classes are not necessarily the same in terms of nature and how they operate. Most of the hedge funds tend to use listed instruments in terms of their application of solutions by a few. And then the second proposal that is being put forward is that the allocation that currently exists for private equity and hedge funds currently sits at 15%, and we are proposing that post the separation, then the allocation for private equity should remain at the 15% level that it currently is, and then potentially into the future continue to increase so that it can start to more closely align with what we see in terms of global pension fund allocation into the private equity space.
What do we see globally on that point, Langa? What is the international benchmark for allocations by pension funds into private equity and into alternative assets in general?
I think South Africa is known for being one of the countries that has amongst the lower levels of penetration in terms of private equity, where even out of the 10% that currently can be allocated to private equity funds, we are probably less than 1% of the pension fund universe, in sharp contrast with many global large institutions and countries where the pension funds allocation sit closer to 20% because of the impact that they can have in terms of driving the developments into the segments that you have highlighted, like infrastructure, private companies as well. And also, I think you will notice that a lot of the big pension funds, taking, for example, CalPERS, in past years have already come out to say that private equity is one of those segments that they're looking to increase their allocations in, whereas we are not seeing the same shift here in South Africa.
John, listening to that, and with your former hat on as the PO of the Government Employees Pension Fund, what is the strength of the private equity asset class that pension funds align to? Why do pension funds generally invest in private equity?
Yeah, no, thank you very much. I think the main thing is that in a pension fund, you want to have a diversified investment portfolio. So the main benefits of alternatives in an overall pension fund portfolio is firstly to increase diversification, and secondly, obviously, lower the level of risk in the portfolio. I think the challenge for pension funds to date is mainly because in South Africa, we've got a defined contributions as well as defined benefit funds. And in a defined contribution, there tend to be an obsession with regular pricing. And I believe that that should not be the obsession. There are ways in which you can estimate the value of members' benefits in a fund, irrespective of whether it's a defined contribution or a defined benefit.
Eugene, coming now to the inherent strength of private equity in the South African context, a proposal that has been put forward now by SAVCA is obviously to increase the allocation to the asset class. Why would that be in the public interest right now?
Thank you, Michael. Yes, pension funds and institutional investors definitely can do a lot more to promote and develop the domestic entrepreneurial ecosystem. They're able to do this through responsible deployment of private equity and venture capital due to the longer-term liability nature of these pension funds. They're able to take advantage of more patient capital strategies such as private equity and venture capital. Through an increased allocation into private equity, it could also drive environmental, social, and governance principles impacting the economy as a whole, which private equity has always been focused on an active and proactive support of entrepreneurs in the ecosystem. And in addition to this, in terms of diversified return, it's shown in the last 5 years that the South African private equity industry has outperformed the all share by 6.3%. And to John's point, it gives you that ability to build an investment portfolio that has different risk return profiles across the investment landscape. And so whilst we've got the pension fund industry investing currently only 175 billion rand into private equity allocations, there is an estimated formalized pension fund industry of just short of 9 trillion rand, meaning at a 10% cap, there's another 725 billion rand that could be invested into, making a big difference to high impact, high growth private investment sector.
What is the current cap? Langa, maybe just come back to you on this issue, because I'm aware that in the industry since 2011 and these caps were legislated, the industry has been trying to encourage pension funds, defined contribution funds in particular. I think a lot of the old DB funds, particularly the state funds, the ESCOM and other funds, are very interested, very alive to the opportunity in private equity, not so much in the DC space. So before we even think about raising the cap, why haven't we even approached our current cap in the South African context? What is the challenge to convince and persuade private equity funds of this benefit if it seems so straightforward? The fact that we see these out returns and it matches the long-term profile of liabilities for members in these funds.
Yeah, I think the challenges that have been faced in terms of reaching the current threshold relate to issues of, as John had said, issues of pricing, where the requirements of daily pricing are something that you would not necessarily get in the private equity space, and therefore you have to stale the valuations over a particular extended period of time and then put that into the valuation for each individual member's portfolio during the unitization process. And then the second issue has always been, I think, there has been, as you said earlier, this perception that private equity is about stripping assets and some form of the dark arts in the investment world. And I think that fear has also been allayed. As you have seen, private equity is one of the big drivers for impact investing. And actually, it has been proven that it's easier to actually measure the impact that private equity funds can deliver than it would be in the listed space. And then thirdly, I think also the amount of knowledge and information and learning tools that have been made available to trustees historically, who in many instances are not investment professionals, has been lacking. But I think the level of education has already stepped up. And as you rightly said, some of the bigger pension funds, your EPPFs, for example, your Sentinels, consolidated retirement fund, already have reached their thresholds, and in many instances find themselves having breached because of the performance of private equity. And I think a lot is happening to change the perception of private equity, and I think that should see us moving forward in the immediate future.
When it comes, Annabel, to the issue of rebuilding the South African economy post-COVID, the debate, as I said in my introduction, has opened up to how we use infrastructure in particular as a catalyst for this growth. It doesn't seem to be for a lack of capital around the place, but potentially for a lack of bankable projects, well-scoped projects. What do you see as the key to unlocking growth through infrastructure development as we look for a post-COVID economic growth engine?
Yes, you're quite right. Look, I mean, three of the levers of growth tend to be consumer spending. We know they're very suppressed, especially after COVID-19. The global economy, of course, there is an anticipated rebound towards the end of this year, but obviously still suppressed. And, of course, fixed investment, as you mentioned. And, of course, the constraints being that government is very financially constrained. And, you know, as you said, turning to the private sector, it really is the only source of savings in South Africa. Government is a dissaver and household savings at very, very low levels. You know, so obviously what the private sector would very much like to see are, you know, large projects that are investable, ones which they can obviously put cash in easily. And I think it comes down quite a lot to regulations. You know, government regulations are very severe. There's a huge amount of red tape, a lot of hurdles to jump through. And, you know, the real problem, I think, is that South Africa is not opening itself up to a real improvement in the ease of doing business like you see in other countries in the world. You know, the government sector tends to, as we said, have a lot of red tape, but also quite unproductive, quite ineffective, not supportive of really getting through, you know, all the regulatory hoops and being as stimulatory and invigorating the business sector as needs to be. So, you know, as the two start to come together and start to dovetail and, you know, work together in terms of meeting each other's needs and requirements, that's really only when we're going to start to see this take off.
John, I know you've been on record a couple of times this year. We've had a conversation around how we mobilize pension funds through framing them as worker capital, investing in growing the South African economy. Just run through that idea and that framing of how we get inclusive buy-in to this idea of using private savings to invest in the future of this country. Because I think the big fear right now is that sabre of prescribed assets. And I don't think anyone likes the idea of being dictated to as to where they should invest. If there's a good project, capital should naturally flow.
Yeah, I think what we need to avoid here is a vicious cycle. The reality is that an economy that's not growing is going to shed jobs. So my view is that when we say worker capital must be at the center of stimulating our economy, it's mainly because our economy needs to create jobs. And the capital or the pot of capital, as Dr. Eugene referred to, which is estimated to be around 9 trillion, is predominantly sitting in pension funds. So the challenge that we typically have is that people think that a company listed on the Johannesburg Stock Exchange, and I know that we are talking about private equity for now, but I thought let me use stock exchange as an example. People think that when you look at ShopRite or you look at Pick n Pay, they think that is what they call white monopoly capital. But what they forget is that these companies are actually owned by workers through their pension funds. So we need to move away from thinking that we don't own these companies and move towards influencing investments within our economy. And that's what I meant by worker capital, or waking what I call the sleeping giants. So when you come to the stimulation of our economy, indeed, as Annabel has made an indication that government to some extent has created confusing policy positions. I mean, if you look at the REAP program, it was one of the most successful programs that government ran, which attracted about 200 billion of private sector capital into the renewable energy space. But later on in the program, government started sending confusing messages, and the more we do that, the more we score our own goals. So we need to be consistent in terms of our policies, and that's why I'm quite excited with this initiative by the presidency. I hope that will actually send a consistent message so that worker capital can partner with government and the private sector to stimulate South Africa's economy post-COVID-19.
Much better than a prescribed assets approach. John, stay right there, and everyone else in the room.